Hello, everyone. Welcome to the RELAC webinar in conjunction with Logic Wealth Management. This is going to be the Empower Investment Fund Changes, What You Need to Know. And without further ado, I just want to introduce Hong Tran.
Hello, everyone. As John mentioned, my name's Hong. I am a principal advisor with Logic Wealth Management. This presentation is basically about the changes that are happening with Empower that are actually happening tomorrow. And it's really the change of your fund lineup. There's a small cap and a mid cap fund that many of you guys are probably in, and that's switching over. So it's going to be what's called a SMID, small and mid. It's just going to combine the two. So we're going to talk about the impact of that and why, how that changes your allocation, as well as if it's a good idea or not. If you have any questions, go ahead and please put them on the chat board, and then we'll get to them at the end of this presentation here. So let me go there. Okay. So about our firm, I'm not going to go over it too much. Basically, we're a independent financial planning firm located in Pasadena, California. We've got about $220 million of assets under management, and that's what our team manages. We do focus on County of LA retired and active employees. So if you guys have any questions, please let us know. We'll be happy to go over them with you. So this is information about myself. I believe this presentation is being recorded, so I'm not going to chat about myself. I feel very awkward about that. So you can certainly read through this now, or you can read it later as this presentation is being recorded. So disclosures, I do have to read this out because that is just the fun things that lawyers let us do. So this presentation is for informational purposes only. None of the information presented today should be construed as legal, investment, or tax advice. Investment options are selected by the Plan Administrative Committee. Empower and related logos are trademarks of Empower Annuity Insurance Company of America. Please consult with your financial advisor for your specific investment needs. And I'll add on to that your legal advisor and tax advisor for those specific topics also. All right, so let's go ahead and start. Basically, we're going to go over the agenda. Really, it's just we're going to talk about what does it mean as far as a small cap versus mid cap versus large cap. And as far as what the lineup means, what you need to know about it, what we think you should do, and some recommended actions that could be helpful for you, and then the advantages and disadvantages on that. So as far as when they say cap, small cap, mid cap, large cap, cap is just short for capitalization. And what that basically means, just a financial term, just means like how big is the company, how much capital is put into the company. So in a small cap stocks, that's about $250 to $2 billion. And most of these are companies that you probably have never heard of. There are a lot of them like research companies. They're companies that are being incubated that really aren't as sizable. And I know that 250 million, 2 billion sounds like a significant amount, but when we're talking about the U.S. economy, that's a very small company to be publicly traded. So it's considered a small cap. One of the defining attributes of the small cap is, again, it's more of a kind of like the baby of the public companies. And so they have a lot of potential, but they can also turn out to be duds. And so there's a lot of it's a lot more volatility in these things. They can have a great year, they can have a bad year, and that has two factors. It's the internal factors, for example, whatever that small cap company does, and their market. How does that impact them personally as far as the company, but also on the global and the national level in terms of the economy. If the economy we see like high inflation and the economy slowing down, small cap stocks are the ones that are hit the most. But in a growing economy where the economy is just chugging along, small cap has the biggest potential for the highest gains. So that's more basically on the spectrum of the risk level. They're on the more aggressive, the most aggressive, but also the most rewards on there. Second step to that is the mid cap. They're basically like they're the teenager to the college years, and that's basically $2 billion to $10 billion. they've established themselves, so there's less likelihood of them going bankrupt. But there's also they're trying to reach adulthood. And so there's a little bit more safety in that. We know that they have a bit of a proven track record. That being said, they still are not the big dog. They're not the ones that control the economy. And that leads us to the large cap stocks. And those are the 10 billion and above. And those are the big companies you've heard: Microsoft, Nvidia, McDonald's, Coca-Cola, all the really big staunch names. And then we hear like too big to fail in any industry. You're talking about large cap stocks there. And those have when you talk about the economy, really you talk about the large cap stocks, is that's what moves the economy. They are they do have potential for growth on it, but they have a little more safety than the small and the mid cap, so they don't have as much potential for the returns, but they also don't have as much of a downturn when the market does go down. So in your Empower lineup, you get to choose between all these investments, and sometimes that's not a good idea because if you don't know what you're doing, having too many tools and not knowing what to do with them isn't very helpful. So here's a list of pretty much all the investments in Empower. On the left side is what we call the target date funds, and on the right side are those individual funds. So we talk about the right side, you have like the Horizon non-US equity, international, the small cap, the mid cap, the large cap. The others are fixed income bonds. But so the top four you see there, the US non-US equity, small cap, mid cap, and large cap, those comprise what they call a fund of funds. So for example, the small cap has a smattering of funds of a bunch of different small cap companies, mutual funds that group together. And so you get like a more diversified portfolio of funds. So now you have to decide, you get those top four funds, and then the bottom four the bottom funds, which is the inflation protected, the bond fund, the bank deposit, the stable income. Those are basically fixed income. They're more they're like debt instruments. So what happens is they usually pay an interest rate, and usually anywhere between the 3 to 6% right now. And they give you like just an annual rate of interest. The bonds do fluctuate based on interest rates, but they're generally considered a lot safer than stocks. So it's more a question of like which one should you choose? It's more a question of the group that you should choose. So you should have some in large cap, some in small cap, some in mid cap for your equity side. And then on the fixed income side, you can have some in inflation and bond funds and the bank deposit. There's different kinds in there. If you're like, well, I don't really know what to do, and even if I do know what to do, that may change. Like when I'm 20 years old versus 30 years old versus 50, 60, 70 years old, those change, right? Because you can be more aggressive when you're 20, but when you're 70, it's a lot more dangerous to be risky. And the reason is because basically at 20, if you take a big market downturn, your portfolio drops, you've got those decades of growth to depend on as you're working. But when you're 70, you're likely not going to have, you're either retired or have very few years before you're going to retire. So you don't really have, a market downturn isn't going to be something that you can survive very easily because you don't have those extra years to work. So when you're, in the one section where you're in your 20s and 30s, you're going to be a little more aggressive. So you'll probably be more like the small cap, mid cap, and large cap stocks. And then have less in the fixed income, and then that changes and that flips when you're 70. So that's basically the issue. Then is like, well, I don't want to have to like change it every year or every 5 years or even every 10 years. That's what the left side is, what they call the target date funds. And the target date fund is basically the year, as you can see on here, you get the Horizon 2020 target date fund, 25, 30, yada yada, up to 2065. And what those are is those are also a fund of funds. And so it takes like the non-US equity, small, mid, and large cap equity, and it pairs it with bonds. And so in the Horizons 2065 fund, what that number 2065 is, that's the year that you're technically retiring, or really the year that you turn 65. And so if you pick the 2065 fund, it gives you an idea that, well, if we have, it's 2025 now, the target date is 2065. That gives me 40 years before I retire. So that fund's going to be much more aggressive now. But then every year it starts selling some of those stocks and buying a little bit more bonds. So it's kind of like an easy way of not having to think about anything. They call it set it and forget it. You buy it into there, and then as the years go by, you get less and less bonds. I mean, less and less equities and stocks, and more bonds. So it's automatic for you. So that's how the investment lineup works with Empower. Okay. So there's a change that's going to happen really tomorrow, November 14th. And what's going to happen is your small and mid cap funds that you have in your portfolio right now, they're going away and they're switching over to the SMID, which is small and mid cap equity. It's going to be one fund. So it's going to combine the two. So if you have all small cap and no mid cap, it's going to change to a small and mid cap fund. And if you had all mid cap and no small cap, now you have a mid cap and small cap fund. It's the it just merges the two. So that may not be what you want. So you have to look at your portfolio and decide that. So if, like I said, if you had 100% in small cap, now you're going to actually be less risky. You're going to have less return potential because it's going to a blend of mid and small cap. On the flip side, if you had a mid cap fund, now you have a small mid cap equity fund. And what that means is that basically you may have had something that you thought was, what your risk profile, your risk potential is. It's going to be more aggressive because it's going to have small cap in there now. So you got to make sure that that is what you want because it's automatically going to default to that starting tomorrow. Okay. So as we had mentioned, you've got a 401k and a 457. 457 is what's called a deferred compensation plan, and a 401k is a true retirement plan. So out of those two types of funds, two types of retirement vehicles you have, they're just basically going to switch over to small and mid cap. As you can see in this chart, small cap is going to switch to small mid cap. Mid cap is going to switch to the small mid cap. Okay, that's going to be the same for the 401k and the 457 plan. So as I just mentioned, we don't think this is a good idea because it doesn't allow you to pick what you want in the fund in regards to your risk volatility. Because some people really want just to have small cap. Now they're forced to have a small mid cap, or vice versa. They may have mid cap. They didn't want as much small mid cap, but now they're forced into it. So we don't believe that having less choice. I can see the point of having simplicity, but I don't think this is the right way of doing it. It's going to create a little bit more options. It's going to create less options for you to get your desired risk profile on here. So some of the options you have, you can move it to a Schwab brokerage account, and then from there, you can buy into small cap fund or into mid cap. You don't have to deal with the small mid cap in there. The cost may actually also be lower in that for example, some of the small mid cap funds are 3/100% that you can buy at Schwab. So it can lower your costs also. And create that diversification that you want, or specification in terms of being specifically in small cap or specifically in mid cap. You don't have to be in both. So Empower, basically, the biggest reasons that they want to do is they want to simplify the lineup so they can just have one large cap, one small mid cap, what they call SMID, and one international, and be done with it. And so, which may not be the best idea for you. It depends on your situation. So again, when we talk about the concerns we have with it, it pigeonholes you into a portfolio that you may not want to have, and the cost may not be what you want in there, and you don't get a choice of that. And we don't, we've never believed that that was good for the consumer. So as far as the Schwab, again, you can move it to Schwab. That'll allow you to have the ability to have what's called open architecture, which means you can buy into whatever you want, whatever ETF you want, and you can go into small cap, you can go to ultra small cap, you can go to mid cap, you can go to both, you can go to one or the other. It doesn't matter. You can do whatever you want on that. And so the nice thing about Empower, it allows you to do that through that portal. Make sure you, if you are concerned about this, make sure you review your portfolio because on November 14th, it does switch. So basically tomorrow it does switch on there. Let's see. So This is just a quick recap of the difference between small cap and mid cap. If you have any questions, please let us know. We'll be happy to answer anything that you have. And I think that's it for the presentation.
Wonderful. Well, yeah, we have a lot of time for questions then. So as Hong mentioned, we can take questions in the chat if anybody has any questions. I see a couple are already coming in the chat. If you also want to ask your question over voice, you can feel free to raise your hand using the React panel down there, and then you just press raise hand, and then I'll unmute you from this side. But just to start, Nina asks, what is the purpose of rebalancing and how often should we request rebalancing?
The purpose of rebalancing is it allows you to not be overweighted. So let's take an example. Take a simple example. Let's just say you are 50% in some kind of equity, whether it's large cap, small cap, international, or a mixture of them. And you have 50% in bonds. And you're like, okay, that's what I want. I want to be just half in the market. So 50% equity, 50% bonds. Well, if the market goes up, let's just say we have a good year and the market goes up 20%. So now that 50% of your portfolio is really about 58% of your portfolio and your 50% in bonds is really about 42% in bonds. So, and again, 20%, it's a significantly good year, but that's not a outlier. That happens quite frequently. And so the purpose of rebalancing it allows you to sell some of those equity that's gone up, because now you're at 58%, you want to be down to 50% because you don't want to take that much risk. It allows you to rebalance into that. It's also the nice thing about rebalancing, it takes the emotion out so that you don't have it's kind of an idiot-proof way of buying low and selling high. And that's the mantra that everyone hears. The first thing you hear about when you do investments, like buy low, sell high. Because obviously you don't want to buy high and sell low because that's never a good idea. So this takes the emotion out so that in this example, again, if you're at 50-50 and then stocks go up 20% and now you're at 58% in equity, you're already thinking, I want to be 50-50. So I want to sell 8% of equity, which is the thing that went up. So selling high. And then we're going to buy, and now that the bonds are down to 42%, we want it to 50%, we have to buy 8% in bonds. And so it's an idiot-proof way of buying low, which is buying the bonds, and selling high, which is selling the stock. And that also works on the flip side. If stocks had a bad year and it's down 20%, you would basically buy stock and sell bonds, or again, buy low, which is the stocks, and sell high, which is the bonds.
Wonderful. We have a question from Victor. And I'm not sure what the context was here, but Victor asks, if that is the case, would it be better to just add a target fund like 2025 instead of choosing the small/mid cap?
You can. Keep in mind that the two things. Yes, that's a good idea, and it is a set it and forget it, and it can be helpful for a lot of people. The two disadvantages of it. The first is, remember, it is a fund of funds, which basically means it carries the large cap, the small cap, the mid cap, and the international in that fund because it's a group, a basket of funds. Remember, now we're deleting out the small and the mid cap. It's just a SMID, right? So it's that the allocation may be skewed a bit. Also, target date funds all have a different way of managing assets. So for example, right now, let's just say you're 30 years old and you're like, okay, at 30 years old, I might want to be 80 or 90% equity, right? So you look at the target date fund, that's great. But now let's just say fast forward, you're 60 years old and you're 60 and you're like, I don't want to be as aggressive because I'm pretty much going to retire soon. And I want to, I'm more concerned about stability than I am missing out on 100% of the market gains. Target date funds have what's called a glide path, which is what we're talking about. As the years go by, it sells a little bit of stock, and buys a little bit of bonds. But each target date fund can be different. So, for example, the Horizons target date fund may have you going into like 60-70% stock until you're 65, and then it drops. It drops to it starts dropping like every year 2 or 3%. But like, for example, Vanguard has what's called a cliff target date fund, which is basically you are at about 70% until about 65. Then at 65, you go from 70% down to about 50%. So it's a massive drop. And so, because their thought process is, well, you're going to retire at 65, so we're going to have you basically invest in the market as long as possible until the day that you retire. And then from there, you're going to automatically drop down to about 50%, which a couple things. One is that doesn't take into account the market. What happens if the market drops the month before, and now you basically sold all your stocks at a very bad time? On top of that, it also assumes that you're going to retire at 65 years old. You may retire at 60, you may retire at 50, you may retire at 70. So the target date fund can be helpful, but it may not be the panacea that everyone thinks it can be.
Wonderful. One of our directors, James Breck, is here, and he mentioned that he'd like to ask to explain a few more things to our members related to context and technical details. I was going to see, James, if you are able to unmute. I just asked you to unmute. It might be easier to do it that way if you're not here as well.
Thank you, John. I did unmute. I presume you can hear me?
Yes, we can.
Okay, Han, thanks for spending the time with our members and providing information. And I see that your partner, David, has asked about that, about one of the things I was going to mention. This population that here is mostly retirees, and we may have some people joining who are still working, but I would think that the majority of this population are retirees. So as you describe the various scenarios, I'd like you to keep in mind to describe and to put in context what retirees can do with their 457 401k. But also, you talked about the ability to self-direct using Schwab. I'd like you to dive in a little deeper at simpler levels and what that actually means when compared to buying a mutual fund versus buying an ETF. Some people may not know what an ETF is. And maybe provide a couple of, make up a couple of case studies where, if you're 65 now, you're retired, you're in you're in mutual fund, what are your options if you put a certain amount of money into the Schwab self-direct? How would that work? And what your advice would be for anybody who's thinking about doing that. I think going back to some of the basics would help our members to understand. And you did a good job describing what small cap, mid cap, large caps are. At the same time, I think the most important part is our members want to know is, how do I keep the money I have and continue to grow at the risk profile that is appropriate for my age, and maybe put things into that context. And that's all I have. Thank you.
Okay. Great questions, James. Let me break it down to 3 parts. The first part is really a 2-phase factor. The first phase is really understanding, like you had mentioned, what am I willing to lose? What is my risk profile? And really that comes down to you break it down, you can just say, if the market was down and I lost 10%, would I still be okay? And then, you just keep going on that. So if you're okay with 10%, you're like, okay, well, I can survive that. How about 15%? And how about 20%? And how about 30%? Right. And so obviously around 15, 20%, people get a little itchy. And around 30%, they get very nervous. I mean, this is your life savings. You worked many decades for this. You do not want to see this vanish. And you do not want to feel like you're shooting in the dark and not knowing what to do. So I think the important thing is, the first factor you need to decide is, what is your risk tolerance? And it's important to know it now, and understanding that you're going to feel different about it, but you have to make sure you take the emotion out. So for example, we've been in the industry, I've been in the industry since 1998. So it's been about 27 years. And I'll tell you, clients in an up market are always, they have all the risk tolerance in the world. They're like, okay, down 10%, no problem. Down 20%, no problem. And then, for example, this year in March, the market tanked just for 1 month. It went down about 23%. These same people that were like, oh, I can take a 10%, I can do a 20%. They were calling me and David, and it was pretty much like, sell everything. We're out of the market. This is crazy. You have to really understand what your risk tolerance is, and that may be why it may be a good idea to at least talk to a financial planner to get an idea of where you're at and have contingency plans. Because, like Mike Tyson has says, everyone's got a plan until you get punched in the face. So once that happens, and let's be realistic, if you're 60s, 70s, you still got 20, 30, 40 years of life left. It's unrealistic to think that you're not going to get punched in the face in the market sometime in that time frame. You need to have a plan for that. And as far as risk tolerance, that's the first factor, first phase. You need to understand what your tolerance is. And so you can stick to the plan, because when the market drops 20% and you get your face punched in, you got to have a plan. You can't just go, oh no, we'll make it up as we go along day by day. I can guarantee you're going to lose a lot of sleep over it, and you're not going to have a non-emotional, pragmatic way out of that. So that's the first step I would suggest. Either talk to a planner, or create one yourself, and really take some thoughtful time on it and decide what your risk factor is. And once you have that, honestly, from there, either work with like I said, work with the planner you have, or decide from there like how much risk you can take. Because now markets, I'll give you the statistics. Markets on average, the average life cycle of a market is between 6 to 10 years. That basically means that from the top of the market to the bottom of the market and back to the top takes about 6 to 10 years. So are you okay with, at the worst case scenario, or not worst case, but a horrible scenario would be waiting 6 to 10 years. You invested in the market and then waiting 6 to 10 years for it to come back to even. And that's probably that's a very pessimistic scenario that can happen. And so if you're like, no, I'm not willing to wait 6 to 10 years, then that gives you an idea of like how much percent you want to have in the equity markets because of that. And as far as James, your question regarding what should you do when you retired, you have a few options. You can keep it in the Empower. You can move it over to Schwab as a PCRA account, or you can actually roll it over to an IRA. And all of those have its own advantages and disadvantages. And I can give you some general ideas about that, but please, again, just like in this disclaimer, it's not just lawyer speak. You really should talk to someone before you do something, because everyone's situation is different. But as far as an IRA, the nice thing about the traditional IRA is that you can move it over to Schwab or Fidelity or wherever you want, and it's an open architecture. So you're allowed to move it and invest it however you want, which may be a great thing and maybe a horrible thing, depending on your plan. You can keep it at Empower, but if you keep it at Empower, keep in mind that you are at the whims of their investment lineup. So, for example, in this scenario, if you were, you kept it in Empower, now you're 60, now you're 70, now you're 80, and you've gone fishing. You're enjoying your life. You're not going to want to keep up with this. You're not going to see, when they change your lineup. And the lineup is probably going to change in the next 10, 20 years again. And so as it happens, you've got to keep up with that. So that's one of the disadvantages of keeping it at Empower, is that you don't get a choice on the lineup on there. The other advantage of having a traditional IRA is that typically as you get older, when you retire, your income drops, right? Because you don't work anymore. So when your income drops, that means your tax bracket drops. So if your tax bracket drops, the nice thing is like when you put it into the 401k and the 457 plan, you got a tax deduction for it. You got it at your tax rate, which can be 22 to 34%, right? It could be 12% if it's low enough. So you're getting a tax deduction at that higher rate. And then when you retire, typically your taxable income is going to go down because you don't have any work income anymore. So that means that your tax bracket's lower. at that point, you may want to convert some of that money from that traditional IRA that you were getting that tax deduction at the higher rate. You're converting that to a Roth IRA. And I know that this is not getting what James was asking, keeping it simple, but this gives you an idea. Like, there are tax strategies out there that can actually save you a significant amount of money if you understand how it works, or work with an advisor that can help you understand how that works. And that's like a guaranteed rate of return just on tax arbitrage. So that's something that is a very powerful tool to have if you can get into the traditional IRA.
Wonderful. I do have another follow-up from James, and then I promise we will get back to other questions. But James has asked, please help our members understand the value of working with any financial planner and why someone would want to work with a financial planner. In other words, what do planners provide beyond keeping things as is?
Okay, so I would say there's two main parts. There's the qualitative and quantitative. And the quantitative is just the pure numbers. Like, they can, you come to them and they present the plan, say, hey, this is what you have, X amount in power, this is your joint savings account, stuff like that. They can break it down and say, hey, this is what you need to do. If you want to, if you're retired now, is it realistic for you to spend how much you want to spend? And also, what are your other goals? Like, what we call legacy. What is your legacy in terms of if you're able to, well, the first part is obviously we want to make sure that you have enough that you can live off of, and including like Social Security, long-term care expenses, things like that. We can help you analyze that. So we, being any financial planner that's competent, they can help you analyze that to make sure that you are on track and that you don't have to worry. If you're 60 now, you don't want to worry when you're 80 years old if you're still on track or not. So a planner can help you keep track of that. It's kind of like, I would say, it's kind of like seeing your doctor every year. Like, some years I don't want to go see them, but as I get older, I realize that I should see them every year to get a checkup. Just because in the best case scenarios, they say it's a waste of time. You didn't get any issues, right? But you want to go see them every year because you want to make sure that that's what they tell you. And they want it that way you can pick up on any health concerns. It's the same thing with finance. Every year you go see a financial planner, and then they can say, okay, here's your finances. Here's what changed as far as like in your life in terms of your expenses went up, your income went down, or vice versa. Here's what changed in the world, like tax, the one big beautiful bill, tax act. Like, how did that affect your finances? Is that going to change anything? How does Social Security, like, it's scheduled to go to minimize benefits in a few years? How does that change things? And what are the new laws for that? So that's where a financial plan can really help you with that. And then on the qualitative side, financial planning can also help just really, putting all together. Like I had mentioned before, like legacy. We talk about making sure that you're okay, but then we also want to make sure, if you're okay and then you've got assets left over, we want to make sure that you are able to get to your goals in terms of like, giving to your kids, giving to charities, leaving that legacy, right? And how do you want to leave it? Some people won't, want to leave it like basically just save all their money, and then when they pass away, give it to their kids, right? But then that's really been the thing for the last 30 or 40 years. But then, really, we've kind of realized that, especially in the American economy, when, people are starting to do better, we realized that, if we live until we're 80 or 90 and then we pass away, we give all this money to our kids, they're going to love it, right? Because they're what are they? The kids are 50 years old. Well, they could have used the money when they were 20 or 30 buying their first house, right? So we help you understand like how that works and like if that will still keep you on your goals, but also make it so that, your legacy isn't that, you held on to this money until you passed away, and then, your kids never got to use it until they were like 60, right? So so we help you understand that, and we help you walk through that. And we've gone through many iterations of client profiles, so we can give you like kind of, more importantly, the questions that you don't ask and that you should ask, but you don't know that you need to ask these. And that's really where the value of the financial planner is, to fill in those gaps.
Wonderful. Your colleague, David, has his hand up, so I'm going to ask him to unmute.
Thank you, John. I just want to add a couple items. First of all, I want to thank Hung for presenting at this webinar. Hong's very humble, so he won't tell you, but he's one of the smartest persons I know. He's a CFP, certified financial planner, and also an enrolled agent. So we refer to him when it comes to financial planning and tax advice. So and for us, what makes us unique as investment advisors, as financial planners, is we actually over the last 18, 19 years, we specialize in helping LA County employees. We have a lot of LA County active employees as clients, and we have many more retired LA County employees as clients. And I talk to them, and I meet with a lot of them on a pretty much daily, weekly basis. And we always joke with them that there's nothing better than Lacera. You know, pretty much all LA County employees, when they retire, they have Lacera. You know, that's your pension. And I always tell them Lacera's gold. And fortunately for all LA County employees, you know, it depends on what your Lacera plan is, whether it's safety B, you know, general D, you know, that'll determine your benefits. So in addition to Lacera, we also tell them about, like Hong said, your deferred comp, your 457, and also your 401k. So when this webinar was scheduled, we had reached out to a lot of our LA County clients and colleagues and friends and family, and that's why they asked me to ask these questions. So we appreciate what you guys do working for the county. I tell all of our LA County you know, employees all the time that, you know, you serve our community and our department. You probably could have got a better job that made more money, but you're a public servant, and we appreciate it. And that's why anytime you have any questions, please reach out to Hong or myself or any of our advisors. So I just want to say hello to everyone, and thank you, everyone.
Wonderful. I'm going to scroll back in the chat and we can get through a few more of these. I'm going to lower it in here. Let's see here. Sorry. We have one new one here. Hong, will you speak to DAFs, including costs?
Wow, DAF question. Okay, so DAF is a donor advised fund. I'm assuming that's what you're talking about. That's a great question. A donor advised fund is I'll talk about the basics of it, and I'll talk about like how that's how we implement it, and then the third part is how that changes with the new tax law, the One Big Beautiful Bill, because a lot of changes have happened with that. So a donor advised fund, it's basically a way of putting money into a big account and then transferring and donating it over the years. So think of it kind of like a 401k, but instead of you put money in and you get a tax deduction just like a 401k, but instead of taking it out for retirement, you take it out for donations, right? So for example, if you put $40,000, you're like, okay, let's just say you donate normally, let's say $5,000 a year, like to your kids' PTA or to, you know, your local animal shelter or whatever. $5,000 a year, and what you can do is if you want a bigger tax deduction, you can actually just donate to what's called a donor advised fund. And then let's just say you donate $30,000, and you're like, well, Hong, I don't want to donate $30,000. I want to donate $5,000. But what happens is you can donate $30,000 to the donor advised fund, get a tax deduction. That's a charitable contribution deduction of $30,000 immediately this year, and then that account can grow year by year and get a and you dictate when you want to take it out. So you can withdraw, you can donate $5,000 a year from that donor advised fund every year for the next 6 years, right? So it gives you basically a way of just lumping together all your charitable contributions for a year, and which is a great tax strategy. As far as your questions, as far as the cost in that, the cost in that is relatively low. It's about 60 basis points, which is 0.6%. And that's Schwab's donor advised fund and Fidelity's donor advised fund. There's a lot of other organizations out there you can do, and they average anywhere between 0.5% to like 1.25%. What we use for our clients is usually Fidelity or Schwab. The costs are low and they're very efficient, and they have great customer service in our experience with that. So another thing is like if you're going to do donor advised fund, you may want to consider donating highly appreciated stock, because that will wipe out any capital gains. And I know that this is going far beyond the intention of this presentation, but I'll just leave it at that. That you know, there are tax implications that can make it more efficient if you donate to a donor advised fund. And as far as how that changes with the One Big Beautiful Bill, there's a few changes that are going to happen. Well, one is that you got to correlate that with The next few years, there's tax law that's going to change things for the next 3 or 4 years, and then it reverts back, it sunsets back. And two of the big ones is that the $10,000 what's called the SALT limit, which is a state and local income tax limit, that goes away. That goes to $40,000 as long as you make less than $450,000 a year. And so that can change how much you want to donate to a donor advised fund, because now you can lump in that with the SALT cap increase. The second thing is starting next year, you're able to start deducting from charitable contributions up to, I don't remember the amount, I believe it's something like $1,000. Please don't quote me on that, per year, where you can donate directly to a qualified charitable donation and get a deduction and still take the standard deduction. So you would not need to itemize. And that starts in 2026, and I believe that ends in 2028. So that can affect if and when and how much you want to put into the donor advised fund.
Wonderful. So I'm digging back into the chat from earlier. I want to make sure to get everyone's questions here. Rick asks, is there a particular fund with a ticker symbol for the new fund so that we can see the holdings? Also, do you know we can get how this new fund has performed for calendar year 22, 23, 24, and year to date?
Great question, and the answer is I have no idea. And the reason I have no idea is they haven't given us the ticker symbol. I will tell you that if it's in line, which I'm assuming, my guess, and I'm willing to bet on that guess, is that it's going to be similar to how they do the large cap and what they did with the previous small mid cap, which is making a fund of funds. It's like basically anywhere between 8 to 15 different funds in them. So the small cap had like 8 to 15 small cap funds. So the SMID, the small mid cap one, will probably use the same type of funds. It'll just be a different portion of it. So I am expecting that the costs in the SMID is going to be similar to the average of the small and the mid cap.
Wonderful. We had a question earlier from Nina that was, what are the rules about switching between stable income fund and large cap, small, mid cap, and vice versa?
There's not really, I believe you can only do it once a day, but outside of that, you can switch back and forth pretty much every day. I don't recommend you doing that, but you can do that. There's no penalties for that.
Okay. We had from Maureen, what's the typical fee or commission for a financial planner?
Sure. So planners can charge in many different ways. I would say the legacy one was commission based, which is basically when they sell you like stocks or annuities or insurance, that kind of stuff. And then they can also do what the other way that we as our firm does is it's called fee only, and basically we charge either % of assets under management, or we charge a flat fee to clients, like if they want just like a one-time plan kind of thing.
Right. And then from Hossam, we have, regarding next year's edition of the 401k, is that an additional $23,500 that can be contributed, or is it a total of $23,500 for both 401k and 457b?
No, it's you can do both. So you would double that. The 457 is considered a non-ERISA plan, which we're not going to delve too far into that, but it's two separate plans. You can do a 401k and a 457. Keep in mind that 401k is one category, 457 is another category. But if you had like a 403b plan, which is another type of plan, you can only do the max on the 401k and the 403b combined. You can't do 23.5 on each one of them. And I believe that the next year, the increase goes up to 24.5.
Wonderful. I think that's all the questions I have so far in the chat. If anyone else has any questions, please do feel free to throw them in the chat or raise your hand, and I will ask you to unmute. We'll just wait another moment or two. But thank you, Hong, for giving this presentation. I think this is
I just realized, I think that someone had, when they asked about the typical fees for that for advisor, I may not have given them as direct an answer. I just want to clarify. Commission based, you're averaging going to be anywhere between 3 to 6% is what the fees are per year. That's what we've seen, at least. And then what we charge is 1% of assets under management, and that goes down as your assets grow, all the way down to 0.25%.
Well, yeah, we'll just give it another few minutes here to see, or another moment to see if anyone has any additional questions. Just so everyone out there knows, we will be posting the recording for this, so you can feel free to watch this over again to make sure that there's nothing that you missed. And this is going to be this is our second actually, in what's going to be a series of informational webinars from Logic Wealth Management. So please do keep an eye out for those. We'll be sending out those over email. I should mention also that we are currently still taking RSVPs for the holiday luncheon, that will be held on December 2nd. Just make sure to get it to your email and register for that because those reservations close on Tuesday. But if there is no further questions, let's see here. From James, we have, if someone wanted to explore the Schwab PCRA, how would they go about it? Is there a cost to it?
David, can you answer that one? You're more of an expert on that, the practice manager on that.
Let me ask David to unmute here. Give me just a moment. There we go.
Hi, thank you, James. That's an excellent question. So a lot of plan administrators, such as LA County, through a lot of employee requests that they have generated, and just to let you guys know what a Schwab PCRA is. A Schwab PCRA is a feature that Empowered and LA County allows all of its employees to access their money with Empowered and basically manage their money that's in Empowered through Charles Schwab. So it's called a Schwab PCRA, or stands for Personal Choice Retirement Account. And it's essentially a self-direct brokerage. It's a self-direct brokerage account. So what we do, Hong does it a lot with our LA County clients, and I pretty much help LA County clients on a weekly basis. What we do is we do the analysis for their Empower account, and we tell them, like I mentioned earlier, Lacera's gold, Empower's okay. Because the reason why I say Empower's okay is Hong went over the investment lineup at Empowered. It's more limited. And Hong said it earlier, what Schwab is open architect. Well, it's basically at Charles Schwab's like going to Home Depot. It's for do-it-yourselfers. You could buy pretty much every publicly traded stock, mutual fund, CD that's available. So we like Schwab, and we're very familiar with Schwab because coincidentally, we custody about $220 million of our clients' money at Schwab. So we've done a lot of our due diligence on Schwab. Schwab has about $10 trillion of client money. They have about 220 million of our clients' money at Schwab. So that's why we're very comfortable recommending the Schwab PCRA to all LA County employees. We generally tell LA County employees that are active that it's a better feature, better option for them than leaving their money at Empowered. And the reason why is when we do our due diligence, looking at the various funds, for example, the large cap at Empowered is the same as a large cap at Schwab, is the same as a large cap at Fidelity. It's basically the S&P 500. The expense ratio for the Empowered large cap is 2 basis points, or 1 basis point, I apologize. The expense ratio for a Schwab large cap is 2 basis points. So they're pretty much equivalent. But all other investments at Schwab, it's either more efficient or more cost effective. And to give you an example, the current small cap at Empowered that's going to be changing tomorrow, that expense ratio is about 41 basis points versus a Schwab ETF or mutual fund that you could purchase at Schwab, and that's going to be about 5 basis points. So during our due diligence and research, we find that if a County of LA employee has 400,000 or more, and if we help them move some of that money from their Empower account over to the Schwab PCRA, they're able to save at least $1,000 to about $1,500 with $400,000. A lot of our LA County clients that are still working have more than 400,000. So some clients that have 600,000, 800,000, a million plus. We have a spreadsheet that does the analysis for us, and the spreadsheet is very simple. It's comparing the expense ratio. For example, if you have 100,000 at 2 basis points, your cost is $200. But if you have 100,000 in a similar fund that's at 41 basis points, then your annual cost is going to be a lot higher. You know, so in this case, you know, we always tell LA County clients that have Empowered that the Schwab is a great you know, the Schwab PCRA feature is a great feature. And then when it comes to a lot of the members and participant on this webinar, once you're retired from LA County, you no longer have the restriction of leaving your money at Empowered. So that's when you could decide, you know, Hong, Dave, we'll like your team to help us move some of that money to a PCRA, or for a lot of our clients, they decide to move it directly to Schwab. So yeah, so at some point, we're hoping that LA County removes some of their restrictions, because right now they do have some restrictions that, for example, every time we help a County of LA employee move their money to the Schwab PCRA, we're not able to do it as an advisor. We have to we have to basically meet with them on Zoom or have them log in, or sometimes you know, if they provide us permission, we'll log in with them and basically help them with it. But we tell them it's a courtesy. We cannot view their account. You know, we actually are not managing their account. They're doing themselves. You know, so that's one of the restrictions that County of LA has, which is good, because the County of LA is very protective for its employees. But unfortunately, that protection is also a restriction. So excellent question. So yeah, if you guys have any more questions, you can feel free to reach out to Hong or myself, and we'll be happy to go over your personal situation and your assets and your finances. So.
John, I'm sorry, can I interject one thing? There was a prior question regarding the limit for the 401k and the 457. I just wanted to clarify, 2026 is 24,500. It's not 23,500. But on top of that, you do have, if you're over 50 years old, you have a catch-up provision, which basically means if you're 50, you can put an additional 8,000 in. So for example, in 2026, you can do the 24,500 plus the 8,000 catch-up. That's 32,500. And that's for each the 401k and the 457. So if you want to like get the gold star and do both, you can put up to $65,000 by doing both the limits and the catch up on them.
Wonderful. We have another question from James. I know we only have a few more minutes here, so just let us know if you guys have to run. But thank you so much again for doing this. James has asked, please explain the tax implications of Schwab ETF/equity versus mutual funds when taking distribution. Please also describe liquidity differences, if any.
Okay. So the difference between Schwab ETF and when we say Schwab, we use Schwab as an open architecture. So the money's at Schwab, but we can use any funds. We can use the Horizons fund. We can use Vanguard, Schwab, Fidelity, a number of different ones. So as far as the ETF equity versus the mutual fund, we prefer ETF because it has a lot more tax efficiency. So in mutual funds, every year at the end of the year, you have what's called capital gain distributions. And so basically it forces a distribution, kind of like a dividend at the end of the year, which you're going to be liable for the taxes on. But for the ETFs, most of them are very tax efficient, or at least the ones we've chosen, so that they either don't have ETF distributions, or if they do, they're very small. Usually about 0.5% to 1% distribution. The average mutual fund has a distribution, depending on the fund, can be anywhere between 2.5% to 7 or 8%. Vanguard's mutual fund a few years ago, I don't know if you guys have heard in the news, they got in big trouble because their mutual fund actually made a distribution of over 20%. So a lot of people weren't happy that they basically got a tax bill for 20% of their entire investment in there. As far as the liquidity in the ETFs and mutual funds are, at least the ones that we've chosen, there's a lot of liquidity in there. The ETFs have a slight advantage in that you can buy and sell throughout the day, whereas the mutual fund gets priced at the end of the day. So there's a one-time pricing. So if you're trying to get out of a mutual fund, you basically, whenever you place your order, it's not going to get bought or sold until 1 p.m. Eastern time. And there's only a one time per day that it gets transacted.
Wonderful. So we did have a question from Lynn that was direct. What do you charge to evaluate someone's profile?
We don't actually, we as a courtesy, we'll look at a client's portfolio or a prospective client or just someone that's of interest. we'll take a look at your portfolio for you, and we can, give you our advice. Like, obviously, not delving so deep into like, your goals or life or anything like that, just specifically on the portfolio itself. We can just say, hey, this is what we see. Here are the pros and cons that we see in this portfolio. We'll be happy to do that. We wouldn't charge you for that. That being said, I would say that if you're engaging a financial planner, that is a good question, but that should not be the only question you ask, because really the whole point of the planner, and the whole point is like, as far as the finances, is understanding the big question, like, like what is the purpose of what we have here? How much do we need? Are we going to reach our financial goals? So your question is a great question, but I think that it should lead into more a bigger general question as far as your finances.
Okay, now we have from Maureen. When did Schwab become a preferred partner with County? I retired in 2017, and this is new information.
David, can you take that one?
Yes, that's an excellent question. Actually, Schwab is I don't think it's considered a preferred partner, but like I mentioned earlier, Empowered and the County of LA, they were encouraged or basically forced to allow LA County employees to have a Schwab feature, and it's a lot of I think we've been helping County of LA employees for 18 years, 19 years now, and as far as I've been helping LA County employees. It's that feature, it's called the Schwab PCRA feature. It's always been available, but a lot of times no one knows about it. Basically, if any of you log on to your Empowered account, look on the left-hand side and scroll down to all the buttons, you're gonna see a button that says brokerage. If you click on the brokerage button, that's how you would establish the Schwab PCRA account. That's where there's another button that allows you to enroll or establish into the account. And then there's another button that allows you to download a PDF and explains to you what a Schwab PCRA is. So in this case, like I said, that feature has, as far as I know, has always been available for all LA County employees. And from our experience with other plan administrators, it's available because the employees wanted it. The employees in the past have told the county and other employers, Empower is good, but I just want something better. I want to basically, choose my own investments. I work with Dave or I work with Hong, and I want them to advise me on what I should pick. So that's an excellent question. And yeah, so look into it. And our only disclosure or recommendation is if you do set up the PCRA, do some research. For us, we do a lot of due diligence because I joke with a lot of our County of LA employees. When you set up the Schwab PCRA feature, you could transfer all the money in your Empowered account up to you have to leave 25,000. So if you have 400,000, you could transfer 375. If you have $1 million, you could transfer 975,000. When we advise our LA County employees on the Schwab PCRA, we have a spreadsheet, we have a lot of analysis, and we would recommend what to transfer only if it's cost efficient and also better performance, more diversification. So for example, with a large cap and Empowered, large cap should be a part of most portfolios. So the large cap and Empowered is just as good as a large cap at Schwab. Is the same as a Vanguard S&P 500, index fund. Is the same as pretty much every other large cap S&P 500 index. So for our analysis and our consultations and recommendations, we would tell our LA County clients and employees leave keep invested in the Empowered large cap. But pretty much all the other investments, like your small cap, your now it'd be your small and mid cap, your international, your bonds, everything else, if you buy it through the Schwab PCRA, it's going to be more cost effective and more efficient. And also at Schwab, Hung is a portfolio manager, so he could delve into this and go into the nuts and bolts. Our portfolios have more than just the standard funds. We buy structured notes and other very complex investments. And we always say the number one goal for our our services is, we call it capital preservation, which is a very fancy word for Dave, don't lose my money. So our number one goal of investing in mine is to preserve our clients' money and of course grow the money as well. So excellent question.
Well, I think we just have one more that we didn't get to yet, which is Margot from earlier asked, have the small cap and mid cap funds been underperforming?
Depends on relative to what. Have small and mid cap been underperforming relative to the market? Yes. So in general, the large cap over the last 10 years has been, I mean, honestly, if you go to any finance webpage, the 3 words you're going to hear are gold, Bitcoin, and NVIDIA. And all 3 of them are not in small cap and they are not in mid cap. They're in large cap. And that's why a majority of the gains on the large cap has been because of those. And so small and mid cap have been underperforming because of they just don't have those high flyers that you've seen. It's pretty interesting to note, actually, the market's up a little over 20%, and that is because of what's called the Mag 7, the Magnificent 7, and those are like the NVIDIA and the Meta and the big tech and the AI companies. If you strip those 7 companies out of the S&P 500, so basically out of 500 companies, if you take out 7 of them, and you have the other 493 stocks in there, the market would actually be down for the year. So all those gains are from that specific significant gains are on those 7 stocks. So it gives you an idea that just the last couple of years, just the large cap has just been dominating everything.
Well, thank you so much, Hong and David, for being with us here today. I think this is a great, very informational presentation, and I'm sure our members enjoyed it. To everyone who's watching, thank you for attending, and do keep an eye out for future webinars from Logic Wealth Management and other webinars from RELAC. We'll be sending out the recording for this, as I mentioned. If David or Hong have any additional materials they'd like us to send, we will send it to those who attended. But thank you all so much for being here, and we hope you have a great rest of your day. And yeah, thanks so much for being RELAC members.